world of personal finance is full of common rules of thumb and shortcuts designed to make managing money easier. But do they actually help you build wealth? Or are they outdated relics for a different generation or a different economic era? Well, today's podcast will review some popular financial rules, which ones are still gold standards in 2026, and which ones you should probably ignore. You'll learn how to customize them to fit your actual life and money goals. Welcome back to Money Girl, everyone. I appreciate you downloading the show. I'm Laura Adams, an award-winning author, on-camera spokesperson, money speaker, and founder of The Money Stack. That's my Substack newsletter. You can learn more and subscribe at lauradadams.com. This is episode 998, which means we are really getting close to the 1,000th Money Girl podcast. I can't believe that we've done that many shows, and I'm planning a special episode to feature comments from listeners like you. So if you want to participate, I would love it. Please leave a brief voicemail at 302-364-0308 to let me know what Money Girl tip has helped you the most over the years, or any other comments that you may have. You may hear yourself on the show, and thanks in advance. All right, let's talk about 8 money rules of thumb. We'll talk about whether they're actually true or false or, maybe somewhere in the middle. The first money rule of thumb we often hear is that your emergency fund should equal 3 months worth of living expenses. So this one can be true or false depending on your stage of life and financial situation. I think most experts recommend building a cash reserve equal to 3 months of expenses because, well, it's better than 1 month and maybe more attainable than 6 or 12. However, you're the only person who genuinely knows the right amount of emergency cash to keep in the bank. Let's say you're a sole earner in a household with many expenses, or you just don't feel confident about the future of your industry or job. In that case, building a larger emergency fund is wise. Losing your income or getting injured could become a huge financial hardship for you and your family. Now, if you're retired or, you're not dependent on earned income to pay the bills, having an emergency fund typically isn't as important. However, you may want a cash reserve to cover large or unexpected expenses in retirement, like buying a new car or having an expensive home repair. In addition, retirees should maintain a cash cushion for a different reason. It's called sequence of returns risk. That's the risk of the market going down right as you need to take withdrawals from your investment portfolio. When you're in the accumulation phase of life, this is when you're working and saving, a market dip is actually an opportunity to buy investments at a discount. However, once you enter the distribution phase, this is typically what we call retirement, a market dip combined with regular withdrawals can cause your investment balance to decline too quickly. So to avoid selling investments when their value is down, a good strategy for retirees is to keep a percentage of their portfolio in cash. It could be in CDs or even short-term bonds. That way, if your stock or your stock funds decline, you can spend from a cash bucket instead. That allows you to wait for a rebound in the financial markets. So whether you're a new graduate who needs to keep a month or two of living expenses on hand, or a retiree who wants a year's worth of cash in case the market dives, there's no right or wrong rule. I hope your takeaway from this tip is that you need to understand the potential risks for your situation and reduce them as much as possible by keeping some amount of cash on hand. All right, the second money rule is that you should contribute enough to max out a retirement plan match. Now, in my opinion, this rule definitely holds if you have a workplace retirement plan that matches your contributions. A match is a 100% return on your money, and that's just too good to pass up. For example, assume your employer matches your 401k retirement contributions up to 4% of your wages. If you earn $100,000 and contribute $4,000 or 4% of your wages, your employer will deposit an additional $4,000. Just like that, you turned $4,000 into $8,000. A 100% return. Now, be aware that some workplace retirement plans have a vesting schedule where you must remain employed for a predetermined period before you actually take ownership of an employer's matching funds. In other words, if you leave the company before being fully vested, you may get to keep some or even none of it. So it's only guaranteed to return 100% if you meet any vesting requirements. However, you're always 100% vested on the contributions you make from your paycheck and all of the potential investment growth from those contributions. All right, money rule 3. You know when your money will double using the rule of 72. Now, this rule isn't magic, it's actually just math. It's a true rule that allows you to estimate how long it will take an investment to double, given its average return. The rule says that if you divide 72 by the rate you expect to earn, the result will be the number of years it takes the money to double. Let me give you an example. Let's say your investment earns an average of 6%. You would divide 72 by 6, and that equals 12. So that means at 6%, you'll approximately double your money in 12 years. Or if your investment returns an average of 7.2%, dividing 72 by 7.2 is 10. That means it would double in a decade. Note that the rule of 72 is not accurate for unreasonably high rates of return, but for interest rates below 12% per year, it's an excellent and accurate rule of thumb for estimating the future value of investments. Rule number 4, your portfolio stock allocation percentage should be 100 minus your age. While this rule of thumb could be true or false depending on your tolerance for investment risk, I generally don't recommend following it. The idea is that as you get older and closer to a target retirement date, you should take less investment risk. That's wise, but the 100 minus your age rule is likely too conservative. For example, let's say you're 55. Well, subtracting your age from 100 leaves 45. The rule says you should devote 45% of your investment portfolio to stocks or stock funds. And the remaining 55% would go to less risky investments like bonds or cash. That might be a good allocation if you plan to retire soon and are somewhat risk-averse. But let's say you're 35. The rule of thumb says you should have 65% of your portfolio in stocks. Most financial planners would say that's way too conservative for a young person and recommend a much higher percentage of their portfolio be invested in stock funds, so they put it to work. In general, young investors have plenty of time to benefit from long-term market growth. Therefore, they should allocate most of their investments to stock funds. Even a 70-year-old retiree may want to allocate a relatively high percentage of their investments to the stock market. That's especially true if they have ample fixed income from Social Security benefits or a pension, or maybe they expect to live decades longer or want to leave money to heirs. Rule number 5. You need life insurance worth 10 times your income. This rule of thumb may be true or false, depending on your goals and your beneficiary's needs. For instance, if you make $100,000, the rule says you need $1 million in coverage, and that is a simple and easy guideline to follow. While purchasing 10 times your annual income in life insurance may be appropriate for some people, it's definitely an incomplete calculation for many. Imagine Bob, who's 35, earns $100,000, rents an apartment, has no debt, and has a non-working spouse. A $1 million life policy is likely total overkill. Bob might need half that amount, depending on his spouse's ability to earn an income if he died. Let's say Linda is 45, earns $100,000, is recently divorced, has a $500,000 mortgage, and 3 minor children that she wants to send to college. $1 million life policy would barely cover the mortgage and future college expenses, leaving her children with almost nothing for daily living expenses if she passed away. She might need twice that amount depending on the value of her assets, savings, and investments. Therefore, instead of using 10 times your income, consider the DIME method when buying life insurance. So here's how it breaks down. We're going to talk about the DIME. D is for debt. Total your non-mortgage debt like credit cards, car loans, and student loans. I is for income replacement. Decide how many years your dependents may need income and for how much. Like, is it $50,000 a year until your youngest child turns 22? The M in DIME is for mortgage. Determine the remaining balance on your home so your dependents can pay it off. And the E is for education. Estimate the future cost of tuition for any children. When you add up any of the DIME needs that apply to you and consider your current assets like savings, retirement accounts, and homes that would pass to your heirs, you may find that your target life insurance number is higher or even lower than 10 times your annual income. So don't let this rule of thumb dictate your family's safety net. And if you're unsure how much life coverage you need to protect your loved ones or leave a legacy, speak with a licensed insurance agent. Rule number 6, buy term insurance and invest the rest. The meaning of this rule is that term life insurance is better than a permanent life policy. While that might be true for many people, there are situations in which this rule is false, and permanent coverage would be the best solution. With a term policy, you purchase coverage for a period, such as 10 or 20 years. If you die during that time, your beneficiary receives the policy death benefit. But permanent life pays a death benefit no matter when you die. In addition, most permanent life policies build a cash value that the policyholder or the beneficiary can use. Let's say you want your heirs or maybe a charitable organization to receive a certain amount of money, no matter how much money you have left when you die and no matter your age when you die. In that case, permanent life is a great solution for achieving that goal. Permanent life can also help heirs pay anticipated estate expenses and taxes after your death. That could prevent them from having to sell estate assets to pay a large tax liability. While permanent life isn't a product that everyone needs, don't disregard it. It can be a powerful financial tool for ensuring that your family or business partner won't experience a financial crisis after your death. Rule 7. You need to save 25 times your income to retire. When you hear someone say you need a certain amount of money to retire comfortably, it's typically not a rule of thumb that's true for everyone. There's no magic number of savings and investments that applies to all of us because our circumstances and goals are different. Some workers have sizable pensions or Social Security benefits that will cover some or all of their expenses in retirement. That means they may need much less in investments than someone without guaranteed income sources. For instance, if a couple has $70,000 in Social Security retirement income between them, and one spouse has a lifetime pension of $40,000 per year, they have $110,000 of guaranteed income per year. In addition, Social Security benefits increase annually with inflation. If this couple has $100,000 of total annual expenses, including income taxes, they have enough income. They may be able to retire and live comfortably on their guaranteed income, even saving about $10,000 a year. But let's say a single person wants to spend $100,000 per year in retirement and expects $40,000 in Social Security benefits with no other guaranteed sources of income. They need to generate an additional $60,000 per year to bridge the gap between their income and expenses. So how much do they need to save to retire comfortably? Well, the answer depends on many variables. such as their target retirement age, their life expectancy, investment growth, and their tolerance for risk. However, a back-of-the-envelope calculation is to multiply the annual income needed by 25. For my single retiree example, that would be 1.5 million in investments. So we would take the 60,000 that is needed in income times 25 comes to 1.5 million when they start retirement. That multiplier of 25 comes from another common rule of thumb that I'll cover next. The eighth rule is that you can withdraw 4% of your retirement portfolio each year. Now, the 4% rule is something we often hear about. It says that the typical retiree who needs their retirement nest egg to last about 3 decades can usually withdraw 4% from it annually. This rule of thumb is a great starting point, but it could be true or false based on your portfolio. This rule is based on research from the early 90s that analyzed stock, bond, and inflation data starting from the 20s. It assumed that you would start retirement with an investment portfolio that's 50% large U.S. stocks and 50% U.S. Treasury bonds, and then rebalance each year to restore that 50-50 stock-to-bond allocation. The study assumed that a retiree would withdraw different percentages of their portfolio at the start of retirement and then increase or decrease that distribution amount each year by the amount of inflation or deflation for that year. And basically, the study found that there were no 30-year periods where a retiree would have run out of money by withdrawing no more than 4% annually. Now, in reality, few retirees withdraw from their portfolios exactly as the research assumed. Income needs always change as your lifestyle and maybe even health change. In addition, not every retiree has a 50% stock and 50% bond allocation that mimics the 4% rule study. However, there is still significant value in considering the 4% rule as a data point in retirement planning. For example, if the single person in my previous example has 1.5 million of investable assets at the start of retirement at 65, the 4% rule says a $60,000 annual withdrawal with inflation increases each year throughout retirement is likely to ensure they never run out of money. The 4% rule may not be perfect, but it does give you a good idea of what's reasonable. For instance, if you have $1 million and want to retire with that amount at 65, but you want $80,000 a year solely from your investments, that would be an 8% withdrawal rate, which is likely too high to sustain for 30 years. In other words, you're probably going to run out of money. I previously mentioned the rule that you need to save 25 times your income for retirement. If you wondered who came up with that number, who came up with 25, it's actually the 4% rule in reverse. If you need an income of $60,000 in retirement, multiplying by 25 gives you a target of 1.5 million. And the 4% rule says that if you have 1.5 million, that portfolio can typically support annual withdrawals of 4% or 60,000 without running out of money over 3 decades. I hope this helps you understand some popular rules of thumb and when they may or may not apply to you. Remember that most rules are general guidelines and benchmarks to help you see if you're on track to achieve goals like building enough savings and retiring. If you're unsure how rules apply to your financial goals, speak with a financial advisor like a retirement planner or an insurance professional. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a Quick and Dirty Tips podcast. I want to thank our great team. Steve Rickyberg audio engineers the show. Holly Hutchins is our director of podcast. Morgan Christensen is our advertising operations specialist. Rebecca Sebastian is our marketing and publicity manager. Nathaniel Hoops is our marketing contractor. And Maram El Naguib is our podcast associate.